Hello everyone, Assalamu alaikum. Welcome to the latest edition of HBL Market Insight. My name is Saad Rajwani and I look after the Corporate South portfolio in Treasury Sales here at Habib Bank. Today we are going to talk about the new primary dealer rules as set forth by the State Bank earlier this week. Ever since the inception of the PD rules in the year 2000, the market for government securities has grown appreciably, both in terms of size, in number, and in terms of the diversity of its participants. The new rules, as proposed by the State Bank, aim towards multiple things. First, to improve the investor base of government securities, enhancing liquidity within the system, improving transparency, and working towards the development of the market going forward. I have here with me Faizan Ahmed, who looks after rates trading at HBL, to give us more insight on the evolution of the PD system. Faizan?
Thank you, Saad. Now, before we dive into the evolution of the PD system, I think it is imperative for the broader audience that we discuss the concept of a primary dealer. From a financial literature standpoint, a primary dealer is a firm who buys government securities either directly from the government or via an intermediary. In most economies, such firms are financial institutions, and the role of an intermediary is more often than not performed by the central bank. As for the intention of the primary dealer, the idea is simple: to redistribute these securities to others, thus also making primary dealers market makers in government securities. Now, moving on towards the crux of the matter. As you very rightly pointed out, the very first set of PD rules were introduced by the State Bank of Pakistan in June 2000. The objectives back then were fairly simple: streamline trading in government securities and encourage the early development of secondary market. Since then, State Bank of Pakistan has introduced minor amendments depending upon the changes required as and when. However, it was in 2012 when they decided to completely overhaul the entire PD system. Again, the intention being deepening the fixed income market. Now, this week, after almost a gap of 9 years, they have introduced a wholesale list of changes to the PD ecosystem. The underlying emphasis this time around is on the diversification of investor base, improving transparency and liquidity, and as far as accelerating secondary market development. To discuss these changes in detail, we have with us Mr. Ayaz Sheikh on the panel. He heads global markets trading business at HBL Treasury. Ayaz, what are your thoughts on the key initiatives taken by State Bank of Pakistan via this circular?
Well, thank you, Faizan, for the introduction. The State Bank has indeed added a host of changes to the regulations at a very granular level. However, some of these do stand out. The first and foremost being the introduction of a multi-tier based primary dealership system. Apart from the existing PDs, the State Bank has allowed for the introduction of two more categories vis-a-vis the preliminary primary dealers and the special purpose primary dealers, both with their own unique sets of selection criteria and as well as obligations. Now, DFIs, investment banks and brokers can act as the supplementary dealers, whereas clearing agencies and securities depositories can enlist themselves as the special purpose dealers. To me, this initiative ties in well with the ultimate aim of investor-based diversification and enhancing the outreach of sovereign debt instruments. There has also been a push to make this market more than just an OTC market. The requisite stakeholders have taken initiatives in recent past with the ultimate aim of providing access to the PIVs and the T-bills through the stock exchange. In this vein, the HBL is in the process of enlisting itself as a market maker at the PSX for these products. This, in our view, will help us contribute to the development of the overall growth of the capital markets in Pakistan. Then I think there's this new requirement of submission of a formal business plan by the PDs. These business plans will need to be endorsed by the top management of each PD. For me, this is a short way of getting the PDs out to step out of their comfort zone and get more of the skin in the game. The onus now will be on the PDs to think out of the box in the way they manage this business, be it creating awareness about these products, client-based development, or even distribution channel innovations. Now, this is something which is very close to our heart here at HBL. We are in the process of developing our indigenous e-platform to distribute these securities to our client base. We are very excited about this initiative, and we expect to roll this out sometime later in the year. Apart from these, State Bank has also specified a very concrete minimum participation and underwriting protocols for the PDs. There has been a lot of emphasis on efficient and real-time market making of these products by quoting live prices on multiple platforms. If all of this, in my view, is implemented in true spirit and form, it is safe to say that we will move towards a much more inclusive financial sector.
Thank you, Ayaz. Now I have Mr. Salman Jafri here, who heads our ALM and structuring desk, to tell us how these changes will affect the overall sovereign footprint. Salman.
Thank you, Saad. As far as the primary dealership business is concerned, the conception in the early 2000s, then the revision to the rules in the 2010s, and now the final iteration. The entire objective of the system since its inception has been distribution of government debt across the economy. As far as current data is concerned, however, when you look at the ownership of marketable securities, which are T-bills, PIBs, and GOP Ijara Sukuks, State Bank numbers suggest that between 75 and 85% of this debt is still on banking balance sheets. So the overall distribution has not achieved that kind of penetration that was envisaged when this system was brought into play. Now, with the current iteration of the rules, particularly the addition of special purpose primary dealers and preliminary primary dealers, along with the existing primary dealers that were already in place for the past decade or so, what is hoped is that there will be a much broader and deeper investor base for these securities to find their home. As far as this entire change is concerned, there is also the State Bank of Pakistan Act in the background, which has recently been put up for approval. And if you look at the nuances of that act, one of those is that the government essentially will no longer be able to borrow directly from the State Bank. And the State Bank itself will become a player in the secondary market for government debt. Essentially, what is happening is that the system has to be broadened for that debt to be placed across the economy, in which case the addition of these two types of players to primary dealers will basically add to the distribution power of the system. So the concentration of government debt on banking balance sheets, that is something that with the changes in the primary dealer rules, we'll also see a paradigm shift in the coming few days, months, years, etc. So as far as the overall big picture is concerned, it's all about distribution. It's all about creating new players in the system. And it's all about making sure that there is not just banking balance sheets supporting government borrowing. It should be spread out across the entire economy.
Thank you so much, Salman. That will be all from us this time around. We will hope to see you soon. Allah Hafiz.